Hello traders, welcome back. In the previous lectures, you have learned about advancing the trade entry positions using moving average, support and resistance levels along with the basics of swing trading strategy. Now from this lecture on to the next couple of lectures, you will learn another method of advancing the trade entry setup using swing trading strategy. So the tool or method we are going to integrate with the basic swing trading strategy is called the Fibonacci Retracement tool. Fibonacci Retracement tool is very popular to the price action traders since this tool helps very much to identify the most probable retracement levels in a price action chart. Before I explain you the method of the usage of Fibonacci Retracement tool, let me first tell you about some of the basic details of Fibonacci retracement levels, which includes a short details of the Fibonacci number series and the important Fibonacci ratios, then the very basic understanding of the Fibonacci levels as their usage and importance on a price action chart, then the calculation method of Fibonacci ratios from the Fibonacci numbers, and then the manual calculation method of the Fibonacci retracement levels on a price action chart using those Fibonacci ratios. So these are very important things to understand since we are going to use Fibonacci levels to identify the most probable retracement levels as well as the Fibonacci expansion levels, so that you will understand clearly that how the Fibonacci levels being calculated and works in a price action chart. So what is Fibonacci, or from where the term Fibonacci came from? Fibonacci is the name of a famous Italian mathematician who had introduced the Fibonacci number sequence to the Western Europe. In mathematics, Fibonacci numbers are the sequence of the integer numbers in which sequence after the first two numbers, each and every number is the sum of its preceding two numbers. This sequence is known as Fibonacci sequence. For example, if we sum the fourth and fifth number of the sequence, which are 3 and 5, then we will have the sixth number of the sequence, which is 8. On the same way, if we sum the fifth and sixth number from the sequence, which is 5 and 8, then we will have the seventh number of the sequence, which is 13, and so on. Now, in technical analysis, these Fibonacci numbers are quite useless unless we use the ratios of Fibonacci numbers, which we can use to identify the Fibonacci retracement levels and Fibonacci expansion levels. So what are the Fibonacci retracement levels? Fibonacci retracement levels are the mathematical ratios between two of the Fibonacci numbers. Most popular Fibonacci ratios are 23.6, 38.2, 61.8 and 161.8. These ratios are mainly used for identifying the retracement levels of a trend, where these levels acts as a support in an uptrend market and resistance in a downtrend market. Most of the times, trading points of a trend tends to form on these Fibonacci levels. So these are very important levels to consider about. Let's say this is a price action chart in an uptrend market where we have a strong bearish pin bar at the top or higher high point of the uptrend. Now this bearish pin bar indicates that the market is now ready to fall down to have a retracement so that a new higher low level can be formed from where price will rise again to continue the uptrend journey. Now we don't know yet that how far price will fall down, but we can predict that retracement level using Fibonacci ratio numbers. So if we calculate the popular Fibonacci retracement levels for a specific price action using Fibonacci retracement tool in a charting software, then we will have at least these three Fibonacci retracement levels, where these levels will act as a support for the upcoming price action. Now let's say if price goes down, then the 23.6 Fibonacci level will act as a first support and will prevent price to go more down. So if you see any strong bullish candlestick pattern at the 23.6 Fibonacci level, then chances are huge that price will retrace back and hence will rise again towards the original trend direction. But let's say if price break the first Fibonacci level and fall more down, then the 38.2 Fibonacci level will act as the second support and will prevent price to go more down. So many times you might see price to rise after getting rejected by the 38.2 Fibonacci level. But still, if price don't respect the 38.2 Fibonacci level and hence break that level too, then the 61.8 Fibonacci level will act as the third support level on this retracement period and hence will prevent price to go further down. So possibilities are high that you will see price to get a pullback towards the upward direction from the Fibonacci retracement levels and hence the uptrend will continue its journey. These are some very impactful psychological levels on a price action chart. In an uptrend market, sellers tend to close their trades in these Fibonacci retracement levels, which gives buyers the opportunity to enter the market more strongly so that the uptrend resumes again. The exact same but opposite setup would be applicable in a downtrend market. Here, the Fibonacci retracement levels will act as the resistance for this downtrend market. If price breaks the first Fibonacci level, then the second Fibonacci level will prevent price to go further up. And if price breaks the second Fibonacci level, then the third Fibonacci level will act as the next resistance and hence will resist price to go more up by breaking the Fibonacci level. So these are the levels from where price tends to take U-turn and move towards the original trend direction. Now that you got the basic idea about Fibonacci retracement levels, let me now explain you how does the Fibonacci ratios being calculated using the Fibonacci numbers. It's very easy to do that. After you have the Fibonacci numbers, take any of the number from the sequence other than 1 and 2 and then divide the number by its preceding number from this sequence. If you do that, then the result of the quotients will be 1.618 or near 1.618. This 1.618 number is widely recognized as the golden ratio number. It's also known as divine proportion. You will find this ratio in so many things in the nature. You can search about that in the internet and there you will find tons of interesting resource and information about this number. In technical analysis, this number has a great use in determining the profit levels using Fibonacci expansion tool. You will learn more about that in the later lectures, where I will tell you about the advanced profit targeting setup along with the swing trading strategy. Now again, if you take any of the Fibonacci number other than 1 and then divide that number by its next Fibonacci number from the sequence, then the result of the quotients will be 0.618 or near 0.618. This 0.618 or 61.8% Fibonacci ratio is our third Fibonacci retracement level. That means if you divide a Fibonacci number by its next Fibonacci number, then you will have the ratio of 0.618 or 61.8 Fibonacci retracement level. Again, if you take any of the Fibonacci number other than 1 and then divide that number by its second next Fibonacci number, then the result of the quotient's value will be 0.382 or near 0.382 number. This 0.382 ratio number is the 38.2 Fibonacci retracement level, which is the second Fibonacci retracement level. Again, if you take any of the Fibonacci number other than 1 and then divide that number by its third next Fibonacci number, then you will have the result of the quotients as 0.236 or near 0.236 number. This 0.236 ratio number is the 23.6 Fibonacci retracement level. And as I mentioned before, that the 23.6 is the first Fibonacci retracement level. So that's how the Fibonacci ratios are being calculated from the Fibonacci numbers. Now let me give you the basic idea of how these ratios are being placed on a price action chart to have the Fibonacci retracement levels. Let's say this is an uptrend market where the most recent bullish rally has been made by rising up for 600 pips. Now as you can see, the most recent candle at the top is a bearish candle. So chances are huge that price will fall down for the market correction after that candle. Now we don't know how far price will fall down for the retracement. So to predict that retracement level, let's calculate and draw the Fibonacci retracement levels on this chart. So for the first Fibonacci retracement level, which is 23.6, multiply 600 by 23.6 and then divide that by 100. So if we do that, then we will have 141.6 as the quotient value. So that means 23.6 retracement of 600 pips is 141.6 pips. So we draw the 23.6 Fibonacci level at 141.6 pips from the top. By using the same method, we can have the rest of the two Fibonacci retracement levels, where the 38.2 Fibonacci retracement level has been placed at 229.2 pips from the top. And then the third Fibonacci retracement level, which is 61.8, has been placed at 370.8 pips from the top. So that's how the Fibonacci retracement levels are being calculated in a price action chart, where the 23.6 Fibonacci retracement level works as the first support for the retracement. And if price breaks the first level, then the 38.2 Fibonacci level will work as the second support, and if price breaks the 38.2 retracement level too, then the 61.8 Fibonacci retracement level will act as the third support in this market correction period. So these are the levels from where price retraces back to continue going towards the original trend direction. So that's how the Fibonacci retracement levels are being calculated in a price action chart. But you don't need to worry about calculating them manually. We will use the Fibonacci retracement tool on our charting software to draw the Fibonacci retracement levels on our price action chart. So that's all for today. In the next lecture, I will show you how to use the Fibonacci retracement levels to identify the possible retracement levels or trading points on a trend using real chart examples. So we'll see you in the next lecture. Till then, have a nice day and goodbye.